budgets, and space programs combined. That single fact captures the magnitude of the shift taking place. Capital is being rerouted from extraction toward cognition. For the first time in human history, the biggest line item on the global balance sheet is not energy, not housing, not transport, but intelligence itself. Late 2025 marks the moment when we cross. This year, the world will spend more than $480 billion building artificial intelligence infrastructure, more than all global oil exploration. Defense seed that threshold, and in hindsight, economists will identify it as the starting point of the intelligence supercycle. Every major bull market in modern history has been fueled by a collapse in some fundamental cost. The industrial boom followed the collapse in the cost of energy. The post-war consumer boom followed the collapse in the cost of manufacturing. The digital boom followed the collapse in the cost of communication. The next multi-decade expansion is coming from a collapse in the cost of computation and reasoning. In 2018, it cost about $10 to process 1 billion tokens of language through a large model. In 2025, the same task costs less than 3 cents. Compute cost has fallen more than 99% in 7 years. When a capability becomes that cheap, it doesn't just improve margins, it rewrites economics. Corporations are responding with capital intensity not seen since the 1950s highway buildout. Global data center capacity is doubling every 30 months. McKinsey estimates the world will spend roughly $5 trillion on AI-related compute, cooling, and power infrastructure by 2030. U.S. corporate AI capital expenditures are growing at a 40% compound rate, easily the fastest growth category in the S&P 500. The productivity response is already visible. Non-farm business output per hour in the United States rose 2.7% in the past year, the strongest reading in 2 decades, and roughly half of that gain can be traced to machine learning deployment inside logistics, finance, and professional services. Analysts who worry that this is 1999 again miss 2 crucial distinctions. First, the revenues are real and growing. Second, the balance sheets are strong. In 1999, the median tech company carried net debt equal to 30% of assets. Today, the median AI-exposed company sits on net cash. The top 7 tech firms collectively hold more than $700 billion in cash and short-term investments. They are funding this expansion from profits, not leverage. The dot-com era was financed by venture capital. The AI era is financed by free cash flow. The earnings picture confirms it. Over the past 12 months, aggregate earnings for the information technology and communication services sectors rose 23% year-on-year, while total S&P earnings were up just 7%. Profit margins for the large-cap technology cohort have reached a record 26%. Productivity at that scale acts like a national growth engine. Each percentage point increase in tech margins adds about 80 basis points to U.S. corporate profits overall. Put differently, AI investment is already responsible for roughly 1/3 of total earnings growth in 2025. Globally, the story is similar. South Korea's semiconductor exports are up 60% from last year. Taiwan's fab utilization is above 95%. Europe's AI software exports have doubled in 2 years. India's information technology services revenue is growing at 28% as Western companies offshore AI implementation work. The International Monetary Fund now estimates that generative AI adoption could lift global GDP growth by 1.4 percentage points annually through 2035. That may sound small, but applied to a $100 trillion world economy, it equates to roughly $35 trillion of incremental output, equivalent to adding another United States plus another Japan. Valuation concerns remain, but the math looks different once productivity accelerates. The forward price-to-earnings ratio for the S&P 500 is about 21, well below the 30-plus levels that prevailed during prior euphoric peaks. More important, earnings revisions are positive in 2/3 of industries for the first time since 2018. Historically, when revisions are broad and liquidity conditions stable, markets compound between 12 and 15% annually for several years. The monetary backdrop supports that pattern. Real rates are near neutral, inflation expectations anchored, credit spreads contained. Liquidity is not booming, but it is expanding, and expansion at a time of innovation is precisely the environment that breeds sustained bull markets. Skeptics argue that capital expenditures are outpacing revenues. In nominal terms, they are right. AI capex is rising about twice as fast as AI-related revenue, but the same was true for railroads in the 1850s, electricity in the 1890s, and broadband in the 1990s. Infrastructure build-outs always front-load investment because capacity must precede demand. History shows that once utilization passes 40%, profit curves steepen dramatically. Cloud utilization for AI workloads has already reached 35% globally and is expected to cross 50% by 2027. That inflection is the moment when cash flow growth accelerates and equity multiples expand, not contract. Another overlooked data point is corporate efficiency. U.S. companies adopting AI at scale report an average 30% reduction in administrative costs and a 20% reduction in time to market for new products. Those are not hypothetical savings. They are quantifiable improvements in return on invested capital. Across the S&P, ROIC has risen from 10.8% in 2022 to 12.6% today, the fastest increase in over a decade. That 2-point change, if sustained, justifies about a 15% higher equity valuation even with no further earnings growth. On the employment side, the data contradicts the fear narrative. Since 2020, the number of high-skill jobs requiring machine learning familiarity has tripled, and total employment in the U.S. technology sector stands at an all-time high of 9.3 million. The Bureau of Labor Statistics projects AI-related professional occupations will grow 26% through 2032, roughly 4 times the national average. Automation displaces some tasks, but it expands the economic pie faster. Historically, every 1% rise in productivity correlates with a 0.5% rise in real wages within 3 years. Early wage data from finance, healthcare, and manufacturing show that pattern repeating. Energy demand is often cited as a constraint, but it may become an accelerant. AI data centers consume roughly 300 terawatt-hours of electricity today, less than 2% of global generation. And utilities are already investing to meet projected demand of 900 terawatt-hours by 2030. Renewable capacity additions are running at record levels, and grid modernization spending is up 50% year on year. The incremental power required by AI is spurring innovation in storage, nuclear small modular reactors, and high-efficiency cooling. The net effect could be an energy renaissance rather than an energy crisis. From a market structure standpoint, the composition of the rally is healthier than most realize. In 2027, companies accounted for more than 75% of the S&P's gains. In 2025, that share has fallen to about 55% as industrials, energy, healthcare, and financials adopt AI and capture their own margin expansion. Breadth is improving. More sectors are participating in the profit upcycle, and that diversification tends to prolong bull markets. In the past 50 years, whenever earnings breadth widened for 3 consecutive quarters, the S&P delivered positive returns the following year 100% of the time, averaging 13% gains. Look also at global participation. Market capitalization outside the United States now represents 49% of world equity value, up from 42% 5 years ago. Emerging market technology and manufacturing stocks are gaining share as supply chains regionalize. Nations investing early in AI, education, and cloud infrastructure, India, Indonesia, Vietnam, Poland, Brazil, are reporting productivity gains between 2 and 4% annually. That convergence is likely to stabilize growth and reduce volatility in global demand, another tailwind for long-term investors. Liquidity underpins everything. Global M2 money supply is expanding about 5% year on year. Corporate bond issuance has normalized with spreads near pre-pandemic averages. Venture and private equity funding, which froze in 2022, has rebounded to a 12-month running total of $780 billion. Roughly 60% of that is directed toward AI, automation, and infrastructure plays. Capital availability is the oxygen of innovation. and the world has plenty of it. That is why downturns so far have been brief and self-correcting. The valuation of intangible assets, software, data, algorithms, is another underappreciated element. In 1990, intangibles represented about 30% of total corporate value. Today, they represent nearly 70%. Accounting standards haven't caught up, which means book values understate real enterprise value. When investors eventually mark those assets correctly, price-to-book ratios will normalize and many supposedly expensive firms will appear reasonably priced. This is the same adjustment that occurred during previous technological transitions. Consider the household sector. In the United States, household net worth stands above $150 trillion, up nearly $30 trillion since 2020. Cash holdings exceed $6 trillion. Mortgage debt as a share of disposable income. Income is the lowest since the late 1990s. The consumer balance sheet can absorb shocks and support demand for goods and services created by the AI economy. That resilience provides the income base for corporate revenues and thus for equities. History shows bull markets end when consumers are over-leveraged, not when they are under-leveraged. One often missed dimension is government participation. Public sector digital transformation budgets in the G20 now exceed $1 trillion annually. Defense, healthcare, taxation, and logistics agencies are among the largest AI customers. Because these contracts tend to be multi-year and inflation-indexed, they provide stability that private markets lack. In effect, governments are underwriting a portion of the AI build-out. That base demand smooths cycles and gives corporations confidence to invest aggressively. Now, regarding valuation fears about specific companies, yes, some trade at high multiples, but the outliers are driving system-wide efficiency. If a firm is priced at 100 times earnings, yet enables dozens of clients to raise margins by 5 points, its social return on capital justifies the headline ratio. Market mechanisms eventually distribute those gains through suppliers, employees, and investors. That's why periods of perceived overvaluation often precede long expansions rather than end them. Long-term equity performance still hinges on 3 inputs: earnings growth, dividend yield, and multiple expansion. The dividend contribution in this cycle may be modest, around 1.5% annually. But with real GDP growth near 3% and productivity adding another 1.5%, nominal earnings could compound at 8 to 10%. Add even slight multiple expansion as inflation stabilizes, and total returns in the low teens become plausible. That's not euphoria, that's arithmetic. Another way to view the cycle is through capital formation. In the last 5 years, global equity issuance averaged $1.2 trillion annually, well below the 2010s average of $1.8 trillion. Companies have been buying back more shares than they issue, reducing float by about 1% per year. Meanwhile, profit pools are growing. Fewer shares and larger earnings mean higher per-share value, even without valuation expansion. Buybacks are expected to exceed $1 trillion in the U.S. again this year. That mechanical tailwind alone adds roughly 3 percentage points to total equity returns. From a behavioral standpoint, sentiment is still cautious. Surveys show retail cash allocations near post-crisis highs. The American Association of Individual Investors. Bullish reading is just 37%, well below levels that typically precede bubbles. Institutional positioning is defensive, with average equity exposure among global balanced funds below historical norms. Bull markets rarely end when investors are skeptical. They end when everyone is all in. We are not there yet. The demographics favor expansion too. Over 600 million millennials and Gen Z workers worldwide are entering their peak earning years. They are digital natives, comfortable using AI tools. Their productivity curve is steeper, and their consumption patterns favor digital goods and experiences with high profit margins. This cohort will drive both supply and demand in the AI economy, reinforcing the cycle. Inflation dynamics are improving as well. AI-driven supply chain optimization is cutting logistics costs by 15%, and predictive maintenance in manufacturing reduces downtime by 20%. Those efficiencies feed directly into lower unit costs, offsetting wage pressure. Disinflation anchored by productivity, not austerity, is the healthiest kind of macro environment. It allows central banks to maintain moderate rates, supporting investment valuations without overheating. All these strands, productivity, liquidity, demographics, sentiment, valuation, interlock into one conclusion. The conditions for a sustained equity expansion are in place. This is not 1999, it is closer to 1954, the beginning of a long era when technological diffusion and capital abundance coexisted. The AI boom may experience corrections, but the secular trend points higher because the underlying economics point higher. The transition we are witnessing will not end with chatbots or image models. It will permeate energy management, healthcare diagnostics, materials science, and finance. Every sector that digitizes decision-making gains scale without proportional cost, and that asymmetry is what drives wealth creation. Markets price that asymmetry long before accountants record it. That is why staying structurally bullish on innovation has historically paid. The final metric worth remembering is time. Since 1950, there have been 18 distinct bear markets in the S&P 500. The average decline lasted 14 months. The average expansion lasted 64. On that ratio, investors spend roughly 4 out of every 5 years compounding. The lesson is simple. Secular trends dominate cyclical noise. Artificial intelligence is a secular trend measured in decades, not quarters. As we close 2025, global equity market capitalization stands near $115 trillion, up $12 trillion in 2 years. The combined revenue of the world's 1,000 largest public companies exceeds $60 trillion and is growing at nearly 10% annually. Those numbers are the scoreboard of capitalism adapting to a new factor of production, synthetic intelligence. The economy is not running out of ideas, it is learning how to commercialize ideas faster. Looking forward, the next decade's winners will be defined by data leverage, operational efficiency, and capital discipline. Firms that align those three will compound. The rest will consolidate. For investors and policymakers alike, the priority is to understand that this expansion is not speculative excess, but structural modernization. The world is reallocating capital from consumption to cognition, and that process, historically, has created prosperity. The conclusion is straightforward. The AI era will be remembered not only for transforming industries, but for revitalizing productivity and profitability at a scale capable of lifting global living standards. Equity markets reflect that promise. They may fluctuate, but the direction of progress remains up and to the right. In every generation, there comes a moment when fear of change yields to acceptance of growth. That moment is now.